Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. There seemed to be some confusion with respect to the date of Holi, with some celebrating it on 7th and some today. No matter when you celebrate, we wish you a very happy Holi. Markets were playing with their own set of red green color combinations, with equities being more red, dollar index and yields being green. This was significant as it was a reaction to Fed Chairman Jay Powell's congressional hearing yesterday, with markets perceiving it to be quite hawkish, leading to the above mentioned reaction. Morning, JK, what was your take on Powell's hearing? Is there a significant shift in stance?
Good morning. Yes, I think Powell sent investors fleeing with his remarks, which almost unequivocally hinted at a higher dot plot and a faster pace of rate hikes. Markets were expecting him to be hawkish after the strong set of data in January, followed by hotter inflation, but was not prepared for this. Many investors had worried that Fed would consider higher rates for longer than previously expected, hearing it directly from Powell is a little different to inferring it from the data. So assets were sold across the markets, including bonds, stocks, and currencies. The telling effect was on the two-year yield, which vaulted almost 20 basis points to touch 5.04%, a new cycle high that was seen last in May 2007. So the bond bears may actually target 5.29%, which was a cycle high in 2007, from where a big drop was seen. So money markets are now pricing in more than 70% probability of a 0.5% move in March. So that's a big shift from 0.25, which was assumed earlier. With the two-year seeing one of the largest daily raises and 10-year giving a muted response, the yield curve has further steeply inverted at 105 basis points. It's nothing but a reflection of markets' increasing conviction about an imminent recession. With the Fed funds rates expected to jump by another 0.75%, at least the larger economy is bound to be stressed. In fact, we had an interview by the ever-present hawk from the Fed, that is James Bullard, who said that economy may still be running fast and strong, but its risk of suddenly falling into a recession still looms very large despite the Federal Reserve's efforts. And he told that he expects the Fed will have to raise benchmark interest rates higher than expected, and that central banks push to combat inflation will soon trigger a recession. Not surprisingly, the stock markets also took all these on their chin. And we had a fall of 1.7% in Dow, 1.5% in S&P 500, and 1.3% in Nasdaq, while the global composite index fell by 1.7%. For the data and event risks for the market, of course, we have this week the second part of Powell's testimony to Congress today. Also, would see the prelude to jobs numbers due on Friday in the form of JOLTS data and ADP numbers tonight, which will be closely scrutinized, of course. The dollar index gained 1.5%. Conversely, euro falling more than 1.5%. Single currency had got boosted earlier as some of the ECB officials had got even more hawkish, and one of them hinted at possibilities of 4 more hikes of 0.5%. But some not so surprising data like Eurozone retail sales and German factory orders, followed by Powell's calls, got the euros sold off, and it was in fact a secular drop in almost all the currencies. Commodity currencies took a bigger hit as Chinese trade numbers, though higher trade balance positive, showed a bigger drop in imports. Aussie dropped after market perceived RBI move to increase official rate for the 10th time in this cycle, looking at it as a dovish hike, and Governor Lowe pointed to challenges ahead for the economy. Yen has reached a very interesting level, almost weakening by 7% from 128.07 in less than a month. That should please the Japanese policymakers who would like to cushion the currency move due to any tweaks in the YCC they may indulge in when they meet on Friday. In my view, this is the most appropriate time for them to move on the policy as US rates are higher. And not to be left aside, the pound was also in the limelight as one of the Bank of England members, Mann, remarked that she sits on the hawkish end of the spectrum. But while she, her views on the need for more aggressive BOE rate hikes are well known, she strayed into the currency markets suggesting that the pound could fall further as the Fed and ECB rate hiked further. She would clearly like BOE to follow that trend, but she has been outvoted. On the Indian rupee side, yes, there was no surprise that there were a bit more follow through on the selling side of the dollar INR, hitting a low of 81.64. But not surprisingly, again, with the event risks ahead, like Powell and jobs report, importers were back in the fray, led by oil companies, and we had a swing back to 81.92 on the closing side. But the important thing is yesterday's hawkish remarks from Powell, which led to dollar index rising to 105.62, which is a 3-month high, did not evoke so much of a response from the rupee side. And we will have to wait and see whether we have more reaction today. But definitely the seasonal factors are keeping the rupee somewhat less responsive to dollar bullishness that is right now very all pervasive. So we may expect 81.60 and 82.30 range for now, and then take more cues from jobs data ahead in the week. Thank you.
Thank you, JK. And just to summarize, after Powell's hearing yesterday, there was he mentioned that they are open to a higher pace of rate hikes. US 2-year has moved up to 5.04%, and now, with respect to the rate hikes, a March hike of 50 basis is expected with a higher probability. And just to recap, listeners, earlier market was expecting a 25 basis hike in March with a higher probability. Of course, dollar index gained 1.5% yesterday. This was despite ECB members being quite hawkish in their statement. And for rupee, we are expecting a 81.60 to 82.30 range with reaction of Powell's hearing expected today. That's it from us today. Thank you so much for listening. Keep managing your risk. We'll come back again tomorrow with another round of fresh updates.